HIMS is up over 200% in the past year, but is now down over 22% several days after it has reported earnings. And this was mainly due to misses on revenue guidance, which has sent the stock tumbling. I actually sold out of the position before it went on to report earnings, and I want to discuss my reasons for doing that whilst reviewing their Q2 earnings, alongside how much money I made during the trade, which was upwards of 120%, and also discuss the business that I've now put my money into after selling out of HIMS. If you get something out of this video, don't forget to leave a like and consider subscribing to the channel to help it grow. So I decided to sell out of HIMS. This is quite a big decision, one that I don't take lightly. There are a number of concerns I've got with the business, which I'll go over in the Q2 sort of review. But this is my position and how much I sold and the sort of money I made on the position. So we overall sold about 51 shares, around about £2,517, and a lot of this was from gains. So it was a position that was up considerably. And I sort of sold just before earnings on the 30th because I was looking into sort of FDA regulations and approval, and I just couldn't get my head around it. And this is sort of something that I've got to be honest about. HIMS isn't in my circle of competence, and it never was. And that was fine when it was a small position, but as it was growing in size and gaining in momentum, it's done really well. I've just sort of decided that it really is best to sell now when I believe that the stock is coming towards fair to overvalued, and is showing cracks in terms of subscriber growth and other things, which I'll talk about. But I made about £1,414 from the position, selling at about $65 per share. And this was near the top. It was fairly well timed for me, which is surprising, as always. And I made quite a bit of money on the position. I think I was up by about 126%. So I did well, and I'm going to talk about my reasons why I sold out of that position whilst going through their Q2 earnings. Here were the results from the earnings report, just in terms of key metrics. We've got earnings per share coming in at 17 cents adjusted versus 15 cents expected by analysts, and revenue growth, where the disappointment sort of came in, around $544.8 million compared to an expected $552 million expected. Now, this is a small miss, but with growth-based orientated stocks like HIMS is, a lot of people depend upon it, and when it misses in revenue in any way, we see sharp falls in the share price. And this fell around about 9% on the day just after the earnings report and has been falling ever since. People almost seemed surprised that the revenue year-over-year growth was de-accelerating to 73% in the second quarter. And I think this was something that was kind of obvious. Like, they guided for it, analysts expected it, but people were still surprised. I saw lots of things on X about it. So I think that the revenue miss is more inclined to think about GLP-1 drugs impacting the margins a little bit. Them not being able to keep pushing new people onto personalised GLP-1 plans and stuff like that has impacted their revenue in maybe a way that they haven't as anticipated as much. And I think this is sort of starting to show a little bit in the numbers. And then on to guidance, which I think has a knock-on effect from the miss in revenue. Here they guided for the third quarter revenue of $570 million to $590 million and adjusted EBITDA of about $60 to $70 million, with margins sitting around 11 to 12%. And for the full year of 2025, they reiterated their guidance that they said at the start of the year, with revenue of $2.3 to $2.4 billion and adjusted EBITDA of about $295 million to $335 million. Now, concerns that I have surrounding that full year guidance are that they just missed on this earnings report by not a small amount, and all of a sudden now we're still getting the same level of revenue guidance for the full year, so they've got to make up a lot more revenue in the next coming quarters, in the third and fourth, to sort of meet that guidance, which is something that is questionable if you ask me. Additionally, they also made an acquisition this year which should add to their revenues, and we're not seeing that change the guidance at all. So that is concerning for me, because it shows that in other aspects of the core business are sort of lowered in terms of growth rates because they're adding around about 20 million in revenue this year in the next 2 quarters from that acquisition, and we're not seeing that reflected in the guidance, with no new guidance despite this being from before the acquisition. And then further on in the shareholder letter, but bringing it back towards revenue growth, this is what I was talking about with their acquisition. So they made an acquisition in the UK, Zava Global. I don't personally know this one, even though I live in the UK. And it's a European digital health provider with furthering their commitment to serving global markets, etc. And they've said that Zava will be expanding their presence in the UK, and they have gained infrastructure to serve customers across Germany, France and Ireland, 4 markets with a combined population of roughly 160 million adults, which is really good for the TAM and something that hopefully they can break into. Now, in the near term, they believe that this will allow them to maintain about 50 million in revenue per year, with a positive adjusted EBITDA margin. So this is what I was talking about, this 50 million number here in revenue. So if we sort of look towards half that, even though their revenues are sort of counterproductive, so maybe 16 to 20 million in revenue for the end part of this year, which will now be considered as part of HIMS revenue. And we're still not seeing any change in the overall sort of guidance given. They're not increasing it, saying, yeah, we're going to get another 20 million this year from our Zava acquisition. This is not something we planned on, and that's why we're raising guidance. They've done different to that. They've decided to keep the sort of levels the same. And that speaks to me of they need Zeta sort of revenue to sort of meet that overall guidance that they've already laid out before they made that acquisition. So that's something that's concerning for me, because you don't want to count on acquisitions like this to meet your revenue guidance. And it's something that I don't think the management team's being that clear on, which is a bit concerning. But overall, their revenue growth still came in very strong at 73% year over year. Despite it being a decline quarter over quarter, it's still very strong growth rates that not many businesses can do. Their net income and adjusted EBITDA both showed quite a bit of strength, specifically net income where there was up 220% year over year. And their operating cash flow and free cash flow were both down because they are working at building up a lot of their inventory from looking at their statements, and they've still got very high marketing spend where they're getting a very good return on invested capital. So I still see this as a good point for HIMS despite their operating cash flow and free cash flows being down. Now, one of the things that I don't like about this business right now, this quarter over quarter, was the subscriber growth, which I saw quite a bit of weakness with. Subscriber growth rates did grow 31% year over year in Q2 for 2025 from 2024. But over a Q1 to Q2 basis, we're seeing that there has been pretty much flat levels. They're still sitting at 2.4 million in subscribers, and they only gained about 50 million to 60 million in this quarter, which is not that impressive and a massive de-acceleration. Obviously, there's a number of reasons for this, as with GLP-1 being something they can't commercially trade anymore. They had to give up a lot of subscribers that were only wanting the commercial availability of that drug and not a personalised option. But this is something that could have an impact on the core business, and we want to see continue to improve. Additionally, revenue on monthly online revenue per subscriber was actually down for the first time in a while, and that was still very good year over year, but something to bear in mind at $74 per share on a subscriber basis. Here we can see what I was talking about in terms of cash flow. There is a lot of investment ongoing with cash and ST investments. It headed up massively, so that's tripled quarter over quarter from Q1 to Q2, and their operating cash flow and free cash flow have gone down into the minus as a result of that. So they're spending more than they're making. They've issued a number of debt to sort of account for this. Their debt, I think they got it at a really good level, at around about 1.1 million or something like that in debt that they got for next to no interest. So that's really good, something that everyone would snap up, I believe, in terms of a business, so that's not necessarily a concern. They also did a bit of dilution, which is not something that they're really covering, and something that I want to talk about as well, because it's a bit concerning as a shareholder, or a previous shareholder as I am. And here we have their weighted average shares outstanding, which are still quite concerning and growing quite quickly. And this dilutes shareholders, lowers their overall value in the business, and something that is not very likeable for a business. Now, their EPS numbers still look good, so there's still lots of positives here, but it's something that I don't like to see, and something that led to me selling out of the business. So I want to highlight it here. So here we've got the current number of 246.6 million in terms of overall outstanding diluted shares, and that's up from number of 229.3 million. So essentially, we've gone up by about 7% in terms of overall growth in sort of outstanding shares, which is overall diluting shareholders by 7%. Simple as that. And yeah, that's fine because the EPS numbers are growing quicker than that, but it's something that limits that growth rate because they are issuing shares and making money out of it. And another thing here is the total stock-based compensation, which is growing quite rapidly, much faster than overall weighted shares outstanding, which is another concern. So the number sits at 224.8 compared to 19. So we're sort of seeing about a 24% growth rate year over year in total stock-based compensation, which is really quite hard to stomach and is quite big for this business. So it's becoming bigger parts of the overall sort of weighted share count, which is not something that we like to see. Now, there's still good news about HIMS, but I just think that's a concerning point and I wanted to highlight it. Finally, we get to my main reason I chose to sell out of this position. This is something that HIMS have always played with the line of, and I knew this going in, so this isn't a reflection upon why to buy or sell the stock, but I don't want this position being a big part of my portfolio when I'm not caught up to date with the FDA laws surrounding GLP-1 drugs. It's a very complicated industry, one that I'm not overly familiar with, being from the UK, with the American healthcare system. I've been stung by the Knights of United Health Group in this sector when companies aren't really in an industry that I understand that well, and I'm starting to realise that I should maybe condense my portfolio to businesses I know are considerably better. So here we have Novo Nordisk ending the deal with HIMS. This is not something that concerned me overly much in terms of the actual partnership itself, but it does concern me for the future of HIMS being likely sued by a big pharma and HIMS playing with that line with FDA approval for GLP-1 drugs. They're still playing with that line. They're giving away personalised GLP-1 drugs, and arguably they're doing it on a big scale. The bigger they get, the more of a target they'll be. And I don't think I really wanted to expose my portfolio to this sort of level of volatility, and HIMS is a very volatile stock. And this is the business I've been buying after I made the sale of HIMS, along with cash investments I've been making into my interactive brokerage account. And the reason that I have sold out of HIMS and put my money into this one, which is an engineering and trade skills style company in Australia, which some people may not like, but I've decided that it's a bit safer. It is mainly because of the sort of business style that I'm sort of seeing. This is vital, mission critical style maintenance service in engineering. They have essential industry skills that make them almost indispensable. They're acquiring all of their competitors. They're leaders in this field. And they're growing rapidly. They had an IPO that was just around 2 years ago. They're up by around about 169% in the past year. And they've got really good things that I like about the business. They've got 95% recurring revenues in the form of contractor-based work for mission-critical sort of services on large sort of companies in Australia, and they have been growing and are guiding for organic growth around about 15%, but have actually been growing around about 40% in the past 2 years through serial acquisitions, which they do, which acquire businesses that align with their sort of overall mission, which is essentially to create a one-stop shop in trade skills for engineering bases. They manage around 22 subsidiaries, and they have around about 60% insider ownership, which massively aligns the management team with my own aims of growing my own money. And I think it sort of incentivizes the management team to reward themselves and their shareholders within the company. And this is something that I like to see. And they're actually buying into this position quite a bit, buying around about 8 million over in the last sort of quarter. So I think that I'm getting signals from insiders that this one's a good buy. I really like the business segment. Yes, it's in a different industry completely, and I quite like that because I don't think that there's any real chance that Tasmania is going to get sued for its practices being on the semi-legal side, which I think is still a concern with HIMS despite how quickly they're growing. And their price to earnings that I work out to now is looking closer to about 14 to 15 times. So it's still trading for a really good PEG ratio, and I see a lot of upside in terms of acquisitions they can make. So I really like this business, and that's sort of one I wanted to explain. I'm up by about 10%, 11% on the position now from when I bought it, and it's just something I wanted to show you guys of where I've put my money. But that's just me. It may not be something that other people like to hear about, and they just want to hear about HIMS and stuff like that, which I'm happy to bring more out on, and I'll be watching their future earnings. Thanks for watching, guys, and I'll catch you in the next one.